Rob Price here from Sound Money. So inflation is really high in 2022, particularly in the US at the moment, and Bitcoin is obviously down at the same time. And there's a lot of jokes flying around, like this meme that I'm putting up on the screen. Uh, you know, how can people call Bitcoin, inflation hedge when inflation is up, Bitcoin's down? Doesn't seem to make any sense. So in this video, I'm going to answer the question: is Bitcoin an inflation hedge? And the clear, unequivocal answer is yes, but the devil, of course, is in the detail. So what you'll learn from this video is four key things. First of all, inflation is really badly misunderstood. I'm going to go into a little bit of economic detail there, but believe me, I'll keep it high level and simplified. It's really important to get our heads around this misunderstanding with inflation. I think it helps us to really contextualize what's going on in markets and the economy. Second, understanding that monetary expansion is really what causes price increases. And then thirdly, Bitcoin targets that. It's a hedge against monetary expansion, and it's been the best hedge against that over the last 10 years. And then lastly, the assets which have strong correlations with CPI or consumer price inflation aren't necessarily the best hedges against that inflation crisis that we're dealing with in a broader sense. Getting right to the conclusion here, Bitcoin is an inflation hedge, but the definition of inflation matters a lot. So CPI does not equal inflation. Now, a lot of people think of inflation, when they think of inflation, they just think of CPI, and that's really not the full truth here. So two things that you need to know about price increases. So price increases themselves, they're impacted by two variables, right? Money supply and productivity. When we increase the supply of money, the quantum of dollars, the quantum of any currency around the world, that will lead to price increases, right? More money chasing after the same number of goods and services will increase prices. And of course, the opposite is also true. If you reduce the supply of money, you have less money, less quantum of money, less quantum of dollars, then that'll lead to price decreases. And the other factor here is productivity, which people often leave out of the equation. The more productive we become, the lower prices will be. So, if we've got the same number of, the same quantum of dollars, but we get more productive, we produce more goods and services, then you've got that same amount of money chasing after this of more goods and services, that'll actually imply price decreases. And of course, the opposite is also true. If we become less productive, if we have less goods and services, we produce less things, but we have the same quantum of money, that'll also lead to price increases. So people often leave this out of the equation. And the implication of this concept of productivity is that naturally, if we were to have no changes in money supply, productivity would actually allow us to produce more goods and services. And as a result, we'd actually get lower prices over time. Of course, not on every good and services, on every good and service, on the services where we're becoming more productive. Um, but if you look back in history, there are times in the world where we didn't have a lot of monetary expansion and small amounts of deflation were actually the norm during that time. So, really important to understand money supply and productivity, really the two key variables impacting price increases. The second thing I wanted to point out here is that CPI, Consumer Price Index, that is one in every country in the world, that's a basket of goods and services. But it doesn't include all prices in the economy. It doesn't even include all goods and services, right? It's a basket that's created by a statistics agency. And then over and above that, there are lots of other prices that are excluded. In particular, asset prices are excluded from the Consumer Price Index. Things like houses, bonds, equities, these are definitely excluded from the Consumer Price Index, the CPI. Depending on the economic conditions, expanding supply of money will actually find expression in different prices at different times and at different rates. So, as an example, over the last 10, 20 years, post 2008, there's been a large increase in money supply, right? Central banks lowered interest rates, they did quantitative easing. There was a big housing boom, there was a big equity boom, lots of money flooded into the economy, into money supply, but consumer price inflation was not impacted much. Why? Well, because most of that money went into asset prices. So that's just an example there of, you can create lots of money in the economy, but it doesn't necessarily go into all prices. It can go into all sorts of different consumer prices, all sorts of different asset prices at different rates, at different quantums. Another example of how this relationship between productivity can also impact inflation. Think about the technological innovation that we've had in the world over the last 10 to 20 years, particularly in electronic products. These have probably dampened consumer prices more than they would have been elsewhere otherwise. To simplify, I think it's more accurate to talk about monetary expansion, productivity, and then asset price increases and consumer price increases. I almost think about those four different components. And usually when people think about consumer price, they only think about consumer price increases when they think about inflation. And in reality, we need to think about those four broader numbers. All right, so I guess the implication here is that monetary expansion is really the cause of price increases, but it's unclear whether that'll impact asset prices or consumer prices. All right, so coming back to Bitcoin, Bitcoin is not a hedge against, specifically consumer prices. It's a hedge against the driver of price increases, which is monetary debasement or expansion, money supply. So in contrast to fiat monies, like all the currencies we use around the world, dollars, rands, euros, pounds, these are not scarce, right? We create them in large quantities. And what I'm showing you there is USM2 money supply. It's just a definition of money supply. Don't worry too much. The quantum on the right hand side, that's the area chart. You can see how it's kind of going up sharply to the right hand side, and then the line is the year-on-year growth, which is obviously volatile, but I mean it's been growing at a pretty strong rate over the full kind of sample size there. But you can also see that rate of growth has generally been trending higher, right? So fiat monies are not scarce at all. And then now what I'm showing you is Bitcoin supply growth, which is by contrast very scarce. So the graph is displayed in the same way. Bitcoin coins issued measured on the right hand side. Of course, there have been a lot of coins issued since Bitcoin's inception, but the rate of growth there is slowing. So you can see it's rising up. It's going towards that 21 million mark. We're already above 18.5 million. It's asymptotically approaching that 21 million mark. And then the growth, the year-on-year growth in Bitcoin supply is steadily decreasing. And interesting to note, that's also measured on the left-hand side, but that's in log format, so that you can actually see what's going on there. Because at the start of Bitcoin, supply growth was strong. It's reduced dramatically, and now is a much lower rate relative to the supply growth of dollars. So and if an asset is useful or desirable, right, it needs to actually be desirable. There are lots of scarce assets that aren't valuable. But if an asset is useful or desirable, scarce assets tend to go up in price over time, right? Because you've got more and more money, more and more dollars chasing after these scarce assets, they tend to go up in price. And the scarcer the asset, the more likely it is to go up in price. So think of houses, right? Equities are scarce. College education is also a scarce asset, particularly here in the States. And no surprise that these scarce assets tend to go up in price more dramatically. And the more monetary expansion there is, the more we also see assets go up in price. And the easy example there is, of course, post 2020, post the March 2020 crash, when central banks around the world came in to create lots of new money, and prices went ballistic, in the economy and financial markets thereafter. Right, so Bitcoin is obviously volatile in price, no doubt, But the scarcity combined with its usefulness implies that the monetary network, it tends to increase in price over time. So, and if you draw that out, if you look at Bitcoin's 4-year percentage change in its price and annualized in this graph, you see that it's a large number. It is it's reducing over time, but still the lowest 4-year percent change annualized is still above 25%. So incredibly strong growth in the price of this scarce asset because it's scarce and because it's being priced in a not scarce asset, which is dollars, and the supply of dollars are increasing dramatically. Right. So coming back to the question here, is Bitcoin an inflation hedge? Well, yes, it's a great inflation hedge against monetary inflation or monetary expansion. No asset in the world is protected against monetary inflation as well as Bitcoin has over the last 10 years. Um, so, a couple of graphs just to show you and prove that point. And of course, listen, over the last 10 years, Bitcoin has gone you know, has gone incredibly higher. So maybe that's not a fair comparison. So what I've shown you here in this graph is Bitcoin's performance since its November 2013 peak, which was one of its peaks previously, and versus a basket of other asset classes, and you see how Bitcoin has dramatically outperformed over that time period. Even since I'm comparing it all rebased to 100 at a previous peak in Bitcoin. And then even if we do the same thing and we compare these assets relative to Bitcoin's peak in December 2017, now, well, there, the performance starts to become more equitable. But remember, we're comparing it here relative to a peak. Drawing this conclusion here that, yes, volatile asset, sure, but Bitcoin has been a great hedge against monetary expansion because it's a scarce asset and it's being compared in this non-scarce asset, which is dollars or any other currency around the world, fiat currencies. Why is Bitcoin weak at the moment when consumer price inflation is high? Well, the relationship between all these variables is not one for one at the same time, right? At the moment, we're actually seeing monetary conditions are tightening. Here I'm just putting up our macro indicator, which is an indicator of monetary conditions. They've been tightening dramatically. They were very loose in 2020, 2021. They've been tightening. That impacts in particular asset markets like Bitcoin dramatically. But it has a lagged impact on consumer price inflation. So consumer price inflation is feeling the impacts of the looser conditions that we had in 2020, 2021, and is now low. And Bitcoin is responding earlier to the tighter conditions. And I think that consumer price inflation will over time also respond to the tighter conditions that we're experiencing, the tighter monetary conditions that we're experiencing at the moment. So when the Fed actually loosens policy again in response to probably lower inflation, that will be priced very early by Bitcoin. Bitcoin tends to, as I said, respond to monetary conditions in response to them very early. It's very responsive to the monetary conditions. And then last point to note here, if one wants to focus on assets that just purely have a strong relationship with consumer price inflation, well, those type of assets do exist. Then you're more likely to be looking at inflation-linked bonds or oil or other commodities, a basket of commodities. These assets tend to have a stronger relationship with consumer price inflation. But whether those assets are actually a good hedge against the broader inflation problem, because the broader inflation problem here is not just consumer price inflation, it is monetary inflation that filters into all sorts of assets and prices in the economy. So the assets which have a strong relationship with consumer price inflation, like oil and broad commodities, don't necessarily hedge particularly well against the broader inflation problem. And you can see that quite obviously if you look at the performance of things like oil, inflation-linked bonds, and commodities over a longer period of time. They've dramatically underperformed Bitcoin. All right, so the key conclusions here for me is that inflation is really badly understood, and hopefully you've here got a stronger understanding that we need to think about monetary expansion. We need to understand that that impacts prices, but it can impact consumer prices, it can impact asset prices, and productivity also has an effect which sometimes people forget about. Monetary expansion is the key cause of price increases, and Bitcoin is a hedge against that, against the core driver of price increases. And Bitcoin has been the best hedge against that over the last 10 years. And focusing purely on assets that have a strong correlation with consumer price inflation won't necessarily be the hedge against the broader inflation crisis that we are dealing with in the 2020s. All right, that's all from me. Please, shoot through your questions below via email, subscribe and like the video, and I'll chat to you soon. Thank you.